We talk about the recent market volatility and just how it has affected certain investor psychologies, if you will, about the sentiment, the things that they're feeling. Have you noticed any difference among your client base at Kathmere with regard to just what kinds of questions you're getting from your investors and clients about the current market environment?
We really haven't at this juncture. I'd say for many of our clients, we've taken the time up front to truly understand what makes them tick, their goals, their objectives, their tolerance for risk. And at this juncture, I think many of our clients feel comfortable with where their investment plan is. We've spent a lot of time really kind of starting late portion of last year into year-end planning meetings, really making sure we're reassessing risk tolerance, making sure our investment programs for our clients are actually tailored to their needs, that they're aligned with their tolerances for risk. Understanding that downside volatility happens in equity markets routinely. We had been obviously on a fantastic stretch and really setting up the stage for saying, hey, valuations have gotten stretched. We've had a fantastic 3-year run here. Let's not forget that downside volatility certainly happens, and are we in the right place for it? And so assessing liquidity needs, spending needs from the portfolio, and really doing kind of that safety check to make sure we're where we need to be. And so I think right now, again, equity markets flat for the year, let's call it, in the US large cap space. Value stocks having a fantastic run year to date. Small caps kind of catching up some, in foreign markets where we've been big allocators on the equity side too, having still a tremendous run. So all in all, I think clients really feeling, I think, good at this juncture. We have not seen really an uptick in the change of tone of questions or anything at this juncture.
Christian, what about you? I mean, the recent market volatility, Nick brings up an excellent point, and it's one thing that maybe investors and traders alike have been grappling with over the last several weeks, is this notion that you can see the kinds of volatility to the downside for those very key parts of that large cap tech market, yet pretty much flat performance on an index basis on a year-to-date level for the broader S&P 500. Some say it's because it's not so much a wholesale risk selling trade, it is just about rotating to other parts of the market. Are you seeing that within your fund world as well? This idea that there isn't panic yet, that people are just getting out of certain parts of the market only to go to others?
Yeah, Don, we have about 40 ETFs diversified from income to technology, and we've definitely seen more people rotate out, take some chips off the table when it comes to technology, and rotate into some of the sectors like energy, materials, precious metals that have had some alpha, that are a little bit more value oriented. We've also seen a big inflow into our funds that really own high quality equities, either here in the US or internationally, that are dividend payers. And then these funds specifically that we have also have the ability to tactically write covered calls as an additional source of income. So you have a couple percent of income from dividends, a couple percent of income from options, and that gives you maybe a 5 to 6% yield, plus a fair amount of upside for total return. So those funds specifically, for example, our US high quality ETF Devo has gained a little bit over 5% this year with the markets being flat. And our iDevo ETF, the international version, has gained a little over 12% with international markets being up about 8%. So these high quality dividend payers combined with the ability to tactically write covered calls are a means to participate in the market, maybe reduce a little bit of volatility, but also get paid along the way.
Christian, can you put some of this in context for us with regard to just the kinds of flows that we are seeing? Amplify, you point out, has a number of these offerings that have these kind of covered call or income enhancement strategies that use options and derivatives. How much do you think your assets under management has seen in terms of inflow? And juxtapose that with the broader market overall for actively managed ETFs and what they are seeing for the demand in these kind of options-oriented strategies for these types of products.
Yeah, so last year, if you look at the ETF industry as a whole, it gained 31% in terms of AUM. At Amplify, we gained about 70% in terms of AUM. Our biggest flow leaders were these covered call or option income products. You know, we've taken an approach that's a little bit different than many other sponsors who are focusing on maximum income. Instead, we're taking a yield smart approach versus a yield trap approach. And we'd say yield smart means attractive income, but still leaving room for capital appreciation. We think that's the smart approach to income. And because of that, we think we've been able to set ourselves apart from some of these high yielding option income ETFs that have outsized yields, that maybe bet on a single stock, or look for stocks that are quite volatile and have juicy option income premiums, but also could be very volatile on the downside. So we think, when it comes to this segment, there's a healthy appetite. Certainly from a demographic standpoint, it makes sense. Then also we're in a midterm election year, which generally has seen the largest drawdown of all the election years. The good news on that is once that drawdown has happened, you've seen the largest capital appreciation of any year 12 months after that midterm election historic drawdown happened. So I think investors are kind of being a little bit more cautious here and bracing for kind of this volatility that historically happens during midterm election years. And of course, years where we've seen now 3 years in a row of really solid market returns.
Nick, what do you make about this volatility regime that we are in? We've seen some bouts of elevated volatility, but if you take measures like the CBOE Volatility Index for the S&P 500, the so-called VIX, when we see those spikes, it's nowhere near the levels that we've seen around other, maybe more relative panicky, if you want to call those situations. In more recent memory, it was around kind of the tariff issues that we saw back in April. If you go a little bit more medium to longer term, it's certainly not even close to the kind of downside volatility that we've seen during things like the pandemic and certainly not the great financial crisis. So if you put all of that volatility movement in context, what exactly do you make of what we are seeing right now? And what exactly is attractive to you in terms of areas of the market that are either more or less than market volatile in these types of situations?
Yeah, as you said, Don, it's been by and large, from a surface level, pretty quiet in terms of VIX. The other thing we've looked at too would be, high yield credit spreads, right? The sensitivity or the extra yield you're earning for lending to riskier companies and taking on that default risk. And I think underlying all of this has really been that we've been in a pretty resilient economic environment, right? 2% or so GDP growth likely to come in for last year. Certainly better than I think many people were expecting during kind of the depths after the Liberation Day announcement. But you've had overall, the economy has been pretty darn resilient. Growing economy, fully employed labor force by and large. Income has continued to grow. That's powered consumer spending. And ultimately, you've seen corporate profitability be very resilient. I think we're looking at 13% or so year-over-year earnings growth. And so I think with all of that in context, there just hasn't been a ton of surface level volatility on the overall market index. As you pointed out, and Christian alluded to, right, year to date, you have seen a bit of a rotation happening underneath the surface within equity markets where some of the leaders of the last couple of years, really in the mega cap tech space, the hyperscalers, have given way now and pulled back some, but you've had a resurgence from smaller cap stocks, from mid cap stocks, from value stocks, foreign stocks for that matter too, where some of these areas that on a relative basis have been left behind, now catching back up to the broader market. But again, underlying all of that, I'd say, has been resilient overall economic growth and corporate profitability, which ultimately drives markets.
Nick, it's interesting as well, because as we talk about some of the bigger themes that are developing in this market, one of the places that we have seen people go in the past in times of uncertain economic outlooks or potential market volatility have been in places like utility stocks, have been in places like consumer staples. You had mentioned the overall economic narrative, and just, I want to say yesterday, we saw one of the biggest consumer products names out there in General Mills see a dramatic slide after its CEO told a conference here in New York that they're seeing consumer stresses and that could be playing out into some of the way that they have to do business or their financials going forward. Even consumer staples companies are feeling some of the pressure around the consumer or perhaps consumer sentiment weakening at times. What exactly then do you make of where people are moving to in this market, given that there are certain places that have been seen as relatively safe in the past that are maybe not immune to that kind of downside volatility, even in this kind of environment?
Yeah, I think one of the main things we've just seen is mega cap growth, what has been leading and dominating the market for the last number of years, driven by a variety of different narratives, particularly being at the forefront of the AI revolution. And you've just seen, I think people have started to get a little bit concerned about what might come ultimately of all the CapEx that's been going, right? These companies have been massively profitable. They've been growing their revenues. But I think one of the interesting things is they've transitioned from very asset light to capital intensive, asset heavy companies. I think people have just been concerned about, A, the magnitude of when revenue and profitability will come from that and the timing of it. and you've seen more of a rotation into relatively more inexpensive stocks, whether that be in the value universe, the mid-cap universe, the small universe. Economically, it's a very interesting environment because, right, we hear so much about the K-shaped economy, where so much of the upper income, upper spending consumers doing very well, whereas perhaps some of those in the bottom half of the income distribution have struggled some. And you've seen that, I think, come through very much in consumer sentiment surveys, where it's been a bit of a paradox, which is how bad consumer surveys, overall consumer sentiment has been in an environment where the unemployment rate is still in the low 4%. You've seen consistent monthly job gains. Consumer disposable income continues to rise in aggregate, and yet you still have such a negative broad-based sentiment.
Christian, I wonder if you take a look at your funds and the way that your models are stacking up right now, are there certain places that you are seeing more of a, I guess, tilt towards? What types of stocks and what types of companies, what types of industries are now kind of coming through to your dividend and options income-based models? So you have basically a base of a certain type of company set, and then the dividends they generate with the option income on top of that. Where are we seeing most of your portfolio tilt towards? What kinds of companies?
Well, right now, I would say international is leading, and it's due to lower valuations and certainly all the spending that's happening overseas on infrastructure and defense. Also, some of the U.S. dollar dynamics. Domestically here, we still see a lot of interest in the larger cap dividend payers. And then from a sector standpoint, we have a natural resources dividend income ETF, NDIV, that yields just over 10%, has a covered call aspect to it, that owns kind of oil, gas, chemical stocks. Certainly energy, basic materials are leaders this year in the marketplace. We also have a junior silver miners covered call ETF. Certainly the move in gold and silver has helped the miners. And that has also been an area that people have looked at, has had some pretty good performance this year, up double digits. So natural resources, oil, gas, silver, dividend payers here in the U.S. and then outside of the U.S., just simply international stocks that are higher quality dividend paying. That would be probably the area that we're seeing most of our inflows in on the income side.
Now, Christian, along the lines of your particular funds and just the types of companies that are being invested in, there's a question, I guess, among some ETF investors that go towards some of these option income and dividend income hybrid strategies about what exactly then dictates the option strategy for your particular holdings. In other words, if you're writing covered calls on your underlying portfolio, how far out of the money are you writing some of those calls to generate the income? And is there a methodology that you look for, or is it a relative value trade based upon just how options prices are stacking up in that particular move?
Yeah, it's a great question because you have to do your due diligence on option income ETFs. They are created quite differently by sponsor. And even at Amplify, we have some different approaches. So our actively managed dividend ETFs as part of our Yield Smart lineup, which are Devo, iDevo, QDevo, tactically write covered calls, generally in periods of market volatility and not that far out of the money, maybe 5 or 10% out of the money. And those calls are generally written on maybe 4 or 5 stocks at most out of a 25 to 30 stock portfolio. On the sector side, where we're more index based, many of the Yield Smart call ETFs are written on a weekly basis on the underlying asset, and usually around 5 to 10% out of the money as well. The key here, at least in Amplify's Yield Smart approach, is to leave room for capital appreciation because we think over time, markets go up and to the right, especially if you're selecting higher quality companies. You don't want to limit that upside. The downside from our perspective when we're out talking to investors is we never have the highest yielding option income ETFs. But when you look at total return, we generally have higher total returns than most option income ETFs that employ similar strategies. So again, we think being smart about yield means balancing attractive yield with upside or long-term capital appreciation and not just going for the maximum possible yield. We think that's a yield trap.
Now, Nick, I see you nodding along the way because you are an investment advisor. So there is a balance, there's a tipping point, and many investment advisors, I'm sure yourself included, look towards things like total returns, right? And there's only two levers in total return. It's the dividend income side of things from a stock, as well as the capital appreciation that goes along with it. Just how much do investors these days, in your mind, Nick, have to focus a little bit more on that kind of total return aspect of their holdings and their portfolio versus just, say, the capital appreciation, which we've seen a ton of pretty much since the lows of the great financial crisis? How do you find what that balance point is, and is it different for different investors?
We generally just advise for all of our clients to take a total return-oriented approach, and that's going to apply across stocks, it's going to apply across bonds, and everything in between within a portfolio. And the reason being, as you mentioned, Dom, right, dividends or income are just one component of return, capital appreciation being the other side. And we've seen probably too often people, I think, get a little bit too fixated on the income component, or yield chasing, as we'll often describe it, where they're going to try to optimize portfolio construction around income. And that can lead to all sorts of distortions, we think, in a portfolio, whether it be in the asset allocation and, overly concentrated in certain areas of the market, moving out of bonds into higher yielding, perhaps equity type securities. Within fixed income, it could be yield chasing in terms of moving further out interest rate risk, taking greater amounts of duration in portfolio, moving from investment grade to high yield bonds, which have dramatically different risk and return expectations. Even within equities, if one's focused on optimizing income alone, right, it could be high dividend yield focused strategies, which will have their own distortions in terms of, right, you're taking a value bet within markets, generally speaking, and that could be a good thing, but the question is that intended or not? Sector over and underweights, right? Traditionally, a value or a dividend yield oriented strategy is going to be overweight on financials, energy, consumer staples stocks at the expense of underweights to tech and communication services. And those could be intended bets, or they might be unintended. But we think oftentimes we just see too often people taking an income focused approach, and that leaves a lot on the table. For us, we focus on having that total return orientation approach, knowing that we can manufacture dividends in a portfolio through systematic or ad hoc sales of a portfolio of securities, oftentimes do so with greater tax efficiency, given the fact that we'll be realizing long-term capital gains as opposed to generating income in a portfolio, which, depending on the implementation, could be a less efficient form of income in a portfolio.